On this episode of Industry Relations, Rob and I try to make sense of the market. Let's go. This is Industry Relations, a podcast that's at the intersection of real estate and technology from an insider's perspective, with Rob HAHN and Greg Robertson.
Hello, everybody, and welcome to another episode of Industry Relations with Rob and Greg. This is your co-host, the notorious ROB, and with me, as always, is the fabulous Greg Robertson.
Hello, Rob.
Dude, so in the pre-show, as we're talking about this particular episode, we might need to do jazz hands and have like videos of puppies ready to go, because I think we want to talk about like macroeconomics, which is like Doom Monger City, baby. Doom.
Dr. Doom.
We got to figure out how to.
Ariel Rubini, where's he? That's always I think of that guy. Jesus.
Seriously. So we're gonna try our best, because we're happy guys, we're optimistic guys generally, even though people think I'm some sort of a giant doom monger. I'm actually very white pilled. I'm very positive about the future of everything. It's just that the short term future maybe not so hot. Right. But so we're gonna try and keep it light-ish, kind of, sort of ish. But let's start. Let's just get going, man. What are you seeing? What's on your mind, Greg?
Well, a couple interesting things to me. I sat in. I don't know if you call it sat in, but I don't know if they call the Twitter things. It's kind of like the talking Twitter, right?
The Spaces. Yeah,
Spaces. Right, yeah. It was our buddy Tyler, MD. Talk about Open Door and what kind of
housing crash. Yeah.
Like
I missed that one because I was traveling, but yeah.
The perfect storm that's going on for those guys where, all of a sudden, rates go up, houses are harder to kind of sell, but at the same time, there's some appreciation as well. And, I guess the argument was like, how can they get out of this situation that this really compact amount of time made interest rates go from 3 to 7, right, and then do they just get rid of all that inventory and then go, and then they can do their model, or what's that's going to cost is whatever. I mean, it's just there's all these situations where everything's kind of, and again, we've talked about this before, it's like, how can we can't learn things, how can we apply lessons from the past to help us not make the same mistakes again when everything just gets so topsy-turvy, right? Mm-hmm. How is unemployment so small, and interest rates so high, and at the same time, the inflation is going out of control, right? I mean, these are just all these different things. It's just for layman or somebody like me that's just trying to make it up. I stop. You have these notions of supply and demand. You have these notions of inflation. You have these notions of interest rates and the Fed. And they just go all out the window with this economy. It's just so crazy. I don't know what to make of it, right?
Okay.
And then the other thing is on a kind of a personal or industry level, you just got to feel, for all these kind of layoffs that are going on, right? And a lot of good people out there. I kind of said something on Twitter that how on Facebook. You have this kind of crisis page where if there's a hurricane going on, yourself is safe. I almost want their LinkedIn to have a thing where if there's a bunch of layoffs at your company, you can mark yourself as like still hired.
Yeah. So mark as safe from layoffs. Yeah, exactly.
Right. So it's like you could find out I was texting friends that for different companies that I knew, like, hey, you still there? What's going on? And you just you hate to see people impacted that way, right?
Yeah.
And then what does that mean for our own businesses, right? For, you have a business, I have a business, I'm working for a pretty large company now. What does that mean for ours?
Yeah.
It's hard to read the tea leaves now, man. I just don't. Help me, Rob. Help me read the tea leaves.
Oh my God, you're asking me? God damn it. So let's caveat this real quick, right? I just look like an economist. I'm not an economist. Okay, I like to say that.
What economist do you look like, Rob?
I used to look like Lawrence Shun. I don't look like him much anymore. But I used to have the similar haircuts glasses. There was a time when I think I could have infiltrated the DC office of NAR, just walking up to the security guard. Oh, I forgot my pass today. Can you just let me in? But I don't think I can do that now. So let's just keep that in mind, right? It's hard to make sense, but I do a lot of presentations where I talk about kind of the housing market from my perspective, which is likely wrong, but whatever, it's my opinion. And one of the key themes that I've been stressing is the fact that we have not had a hot housing market. Everyone wants to say, 2020, 2021, it was the craziest, hottest housing market we've ever seen. A lot of the folks who are talking about a housing crash think it's all about homes are completely overvalued, right? I mean, that's what we've heard from a lot of folks, right? I just don't think that's true, right? And I think I showed this graph once to you. Let me see if I can pull it up real quick. But fundamentally, I think my position is that we have not had a hot housing market. We've just had dollar devaluation, right? And like I said, I've done this before. I'm going to just pull up a quick slide from a recent presentation so I could share it with everybody. Okay. How do I share? Let's see. Present. Slides. Slides? No. Sorry. I know this is wonderful. I should have probably prepared this already. All right. There. Let's get that on. All right, can you see this? So this is a slide that I did some computation earlier this year. I was like, holy crap, is this right? And I think it's right. So this basically, when you plot the Case-Shiller price index to the U.S. money supply, this is what we see. And my main point behind all of this is to say, look, this was a bubble, right? Because in other words, people want to say 2022, we have this giant bubble, the bubble's going to burst. I'm like, we don't have a bubble because this was a bubble. Right, when the price completely unmoored from money supply, right, because of ninja loans, because of stupid shit that we did, from 2000 to 2006. Okay, bubble bursts, and then we have this dramatic fall in home prices. It goes under, way under for a while, and then ever since 2011, 2012 or so, when we came out of that post-bubble collapse. I mean, remember 2020, 2010, 2011, dude, it was not a fun time to be in real estate. We've pretty much tracked money supply. And boom, here's COVID. We print 40% of all US dollars in existence. Look at what home prices do. So my fundamental point behind this is I just don't think we're in a housing bubble. And we get rid of this, right? I just don't think we're in a housing bubble. I think we're in an everything bubble. We're like a money bubble. You know what I mean? And that then makes everything kind of make sense. Because why do we have inflation? Because we have fucking so much goddamn money, right? Why is the labor market so low? Because we've been paying people for 2 years to stay at home, right? And quite frankly, a lot of folks have given up looking for work. So the problem is you look at the unemployment rate, and that requires looking at people who are filing for unemployment or, do you know what I mean? It's not, the real number is the labor force participation rate. And that's all 40-year lows or whatever, right? So the labor market's not healthy. At the same time, because of inflation, real wages are down. And there's, in fact, let me share this screen. Sorry, I'm going to put this up because it's worth it. And people who've seen me speak live, they've all seen this before, but whatever. And if you're just listening to us on audio, you might want to hop over to YouTube and check it out. Can we get this on screen? Right. So the point is look, in nominal terms, wages have been going up, right? But if you look at it as inflation adjusted real terms, it's pretty flat, right? And recently in the last year or so, last couple of years, because inflation has been so high, the latest September stat, I think it was 8.2, way more than what people expected, inflation. So September CPI print came in at 8.2. Hidden in that was the fact that September real wages are down month over month. And year over year, I think real wages are minus 2%. So the average American is making less money in real terms. Everything's going up. Food, gas, everything is just through the roof, housing is through the roof, and we can get rid of this. I think that's what's going on, right? So for us in the real estate industry, I think the big issue is the prevailing sort of conventional wisdom, I think, is that housing is overvalued, right? And even if you don't think housing is overvalued, you look at just 7% rates, incomes are flat or declining, everything's more expensive, people just don't have as much money to spend, so guess what? They're not going to buy homes, right? Buyer demand is like falling through the floor is the narrative, right? And the unfortunate thing, I think, for the industry is all of the housing stocks are just getting hammered.
Oh,
all of them, right? And you know, as you know, I'm very long Opendoor. I'm very, very pro Opendoor. I'm very bullish on it. And they're like at $2, $2.50, something like that. I mean, it's pretty brutal. And I'm like, maybe I'll keep loading up. I don't know, because if you have faith in the company, the challenge is, as much as I want to load up, if they can't keep getting capital, then their business model does not work, right? Because the entire Opendoor iBuyer business model was applying capital to the problem of broken transactions, right? If they can't get capital, then it just doesn't work. People are focusing on like, well, they're losing money with every home sale. Like, that's fine. You can lose money, right? It's a point that we've made before. We've debated about iBuying and Opendoor. I'm like, look, if you're a market maker, you don't make money on every single trade, right? You lose money on some trades. The idea is, though, over the entire sort of portfolio of all the trades you do, you win more than you lose, right? So in bizarre economic times, and I think it's just weird to me, like how in the industry we just want to look at Opendoor and be like, it's broken and it's fundamentally flawed, blah blah blah. I'm like, you know, there are market makers in nickel, right, in oil and gas that lost their ass last year, right? And it's like, well, those are fundamentally broken. No, they're not. They're market makers. It's what happens. Sometimes, you know, those shit happens and you lose money, and other times shit happens and you make fortunes. Like, it just, that's the nature of market making. But I think that's happening. So capital's dried up, and I think a lot of companies are just making decisions to say we need to cut, right? So, I mean, Picasso just announced a big 30% layoff, and they're healthy. They're a unicorn. You know, they're well funded. It's just they're doing the smart thing by saying, "Hey."
I think it was smart for those guys. Because, you know, you hear 10%, you hear 20%. I think they did it, just said, screw it, 30, boom.
Right.
One and done, instead of kind of a death by 1,000 cuts. So I think that was a good move.
And I think a lot of folks are going to do that, right? I mean, you know.
Well, we talked about this with Spencer, one of the last shows we did. And the problem is that, you know, with these depressed market conditions for all the real estate stocks, it doesn't give a lot of VCs and other investors and there a lot of confidence that, well, hey, maybe later on, you know, going public or anything else is a good idea. I mean, you know, here's the classic part. In some sense, Gary Keller looks like a genius for not going public, right? And I think we all knew that. I think a lot of it was just because his own, you know, there's a revolving door there, and they couldn't, you know, get the management right. But I mean, that may have been, you know, looking back, like a blessing in disguise, because otherwise, who knows what that IPO would have looked like, and who knows why that stock would be down now. I mean, everything's down. Remax is down. Anywhere is down. Compass is down, obviously.
Yeah, everybody's down. Even EXP is down, right? Yeah. But on the Gary Keller thing, it's like, no, I don't actually think that's a fair assessment, because EXP is kicking their ass.
Yeah.
And a big part of the reason is because EXP has publicly traded stock, so they can incentivize, or, you know, they could do recruiting and retention to the stock thing. And again, whether we think that's a Ponzi scheme or not, that's immaterial. Like, that's the thing that's leveled at EXP. I'm like, it doesn't actually matter. It's working, and they have 89,000 agents, growing. They're profitable. You know, like.
No, I mean, I think Glenn Stanford put out a tweet about the market cap they have now compared to some of the other things, and it reminded me of that. That famous Steve Jobs thing where, you know, they had asked Michael Dell what to do with Apple back in the day when it was really struggling. They says, shut it down, sell it off, and give everything back to the investors. And then his thing was like, well, today we reached a market cap where we were over Dell.
Yeah.
I just wanted to point that out, right? So it was basically Stanford's kind of, Steve Jobs moment to kind of put that tweet out.
Yeah. So I don't know about that specific thing, but as a general thing, though, what it does mean is because the overall market sentiment is so bearish. I mean, here's how I look at it, right? I think 3 months ago, let's say 4 months ago, right, the concern was inflation, right? Now, I think the concern is economic collapse.
Well, I mean, I still think that the concern is inflation. I mean, the latest, what is it, CPI? Is that the right?
Yeah, CPI. Yeah,
it's still being very, very, very stubborn, right?
Yeah, but I mean, what I mean is that's not what most investors. That's not what the market's truly concerned about anymore. That's what the Fed and policymakers and politicians are worried about is inflation, right? Because politicians tend to lose elections when there's high inflation.
Right.
Right. So I think the market, though, what they're concerned is economic collapse. Right. And there are a bunch of people who think this is a good thing. Like, let's be honest about it. Like, there are a number of analysts and a lot of bankers and, fund managers who are like, oh, it's a wonderful thing. And you see this most in crypto, right? Where there are a lot of folks who are very long crypto, myself included, right? Who really believe in the power of crypto and Bitcoin, all these things. But we're like, hey, you know what? Crash away because we need to wipe out like 90% of this just bullshit hype crap that's out there, right? And then whatever's left will be the true, like, this is really what's going to, deliver the value and take things in the future. I think there's a lot of that in the economy as well, right? A lot of companies probably need to go out of business because they're not providing any value, right? They're not actually creating any, cool products or services, right? Now, having said that, for anyone's listening, because I do get asked this sometimes, again, I'm not an economist, right? Take it for what it's worth. But there are some analysts and economists that I do follow, and I think they're very, very good. And I think they're totally worth kind of following, reading, checking out. And the two that really come to mind is Doomberg. And then Doomberg has a Substack. Doomberg is Doomberg. Amazing.
Great name.
Phenomenal, right? And the other one is Forest for the Trees, a gentleman by the name of Luke Gromen. For me, those two guys have been the most sort of illuminating, enlightening, and they're kind of, doomy right now because they have to be, but I think they're onto something. So just want to point that out.
But I mean, but people still, they get a promotion, they have to move. They have a divorce, they have to move. They have a kid, they have to move.
Yep.
These are life events that happen that will still cause real estate to be transacted, right? They
Absolutely.
lose, they got to move, right? So,
absolutely.
I mean, and if you look at I've always been, and I don't know if you have this chart, but it's just like the total sales, going on. I mean, there's a big bump in 2020, 2021, but I mean, 5.5-ish, right? About right. And that just kind of stays steady there. So, I mean,
so I was just at an event yesterday in Nashville. I spoke at Benchmark Realty's expo, and Dan Duffy from United Real Estate was there just pointing this out, that in the depth of the depression of the Great Recession, right, the housing market, the bubble burst, and the foreclosure crisis, all of that, right, in the worst year of that collapse, 4.5 million homes were sold.
Right. Shit ton.
Right. So at the exact time when everyone's like, oh my God, nobody's going to buy houses, the market has collapsed, the bubble has burst, panicking, freaking out, like 4 million or whatever, like millions of homes are sold, right? Because to your point, housing is like not one of those things, right? And this is the point I like to make, right? So in my private thing, and I tell everybody, look, I'm not an investment advisor, go talk to your blah, blah, blah. My personal philosophy around this is, what do I want to invest in? I want to invest in stuff that the Fed can't print, right?
It's land.
So like it's gas, it's oil, it's gold, it's silver, it's real estate, right? Because you can't just, and it's not just the Fed, right? So I don't want to invest in NFTs, not because I don't see the value of collectibles. I totally get that, right? But it's not the sort of thing that computers can just create, right?
Right.
Facebook, like No, you actually have to do these things. These are physical. And I think, so if there's a larger theme here is something I've been thinking about for a long time. I haven't written this. I need to really think about it. So this is a great spur, right? I think what we're seeing sort of a fantasy economy give way to what I like to call the reality economy. Right? To give you an example, as horrible as it is, look at what's happening in Europe right now, right? Where Germany and, whatever, France and all these like European countries, all of a sudden, like, okay, because of Ukraine, the Russian pipelines issues, they don't have access to natural gas. And all of a sudden, okay, we need to subsidize our families. We need to help these people pay their bills. So they're going to print money. They'll do whatever, right? And I'm like, okay, that's cool. That doesn't create a single gallon of oil, right? Like, you need you need these things. Like, if you don't put natural gas into your heater, you don't have heat. It doesn't matter how much money or the NFT, that doesn't matter. Reality actually sort of reasserting itself. And I feel that way about just like the world right now, that we're moving away from, a good 30, maybe 40 years of like, financial manipulation and this prices and money markets and all this to actually, it turns out we need real things. Like we need like food, that's real. You can't have virtual food. You need houses, you need real estate. That whole conversation around the metaverse. Turns out, you could buy whatever metaverse land you want. That doesn't do anything for you when it's raining. Like you need a roof over your head, or energy, right? Like you can't just print that stuff. Like you actually have to make the stuff. So I think that's a big trend of what's happening, which I think then means that we're about to go into some major shift, right? The Great Reset, maybe, like that language, maybe the Great Reset is we're resetting from a world where it was all about money and the Fed and interest rates and this and that to actually, it's not about the money, the Fed, it's about how many chickens, do you produce? How much wood, how much land, like, the housing, people are all worried about housing prices and blah, blah. I'm like, okay, are we building houses? Because you know what, like, you could snap your finger and say, whatever, we're going to make prices all this, that, and the other thing, affordability. Okay, cool. Do we actually have physical brick and mortar and wood that's already up, right? And the answer is no. Okay, now what? Do you know what I mean? It's one of those like reality reasserting itself. I think that's a general theme.
Yeah, and the other thing though is that, going back to kind of people employment and everything, I just see a lot of people who are doing these either side hustles that become real hustles, right? Where, the real job, where it's not even like they're creating things, but they're just understanding the power of the internet and how to leverage that into a business. And
sure,
not maybe creating things, but like solving issues, being smarter about it, just leveraging all that's out there before that. I think that a lot of big businesses kind of understood, but now solo entrepreneurs are kind of getting, right?
Sure.
And I wonder, with these employment rates that they keep producing, and you're saying that there's the other stat that's like the total market of people, right?
Yeah, the workforce participation rate.
Yeah, right. I mean, how many of those people are just basically, making butcher blocks and selling them on Etsy, right?
Who knows?
Who knows about that stuff? I mean, what are we telling people here? What are we telling vendors? What are we telling realtors? What are we telling MLSs and associations? I mean, how does this affect? I mean, what should be they looking out for? I mean, I have my own theories and how I would.
Well, let's hear your theories, because my theories are pretty dark.
Yeah, I mean, I started. Dan and I started WNR Studios in 2008. Right. I mean, we had rented some. I've told the story before. Some cubicles from an architect's office who was basically going out of business and would take any money you can get. And we had our kind of radio on still, if you can believe that. And I remember when McCain was saying, well, I'm going to shut down my campaign and we're going to go focus on the economy.
Yep. I remember that. Yeah.
And this is the great real estate financial crisis, right? I mean, and we're two dumb shits excited about building a real estate software company, right? So
sure.
There is opportunity at starting from the bottom. I don't know if we've hit the bottom here, but we're certainly at some point here. I would encourage a lot of companies that, they're going to cut or they're going to do anything else. I mean, now to me, the time could be to build where when we come out of this, the investments you made during this downturn, when it turns, you're ready to go while everybody else is kind of caught flat-footed.
Of course.
This can be contrary to, what a lot of think, because, a lot of these companies are basically slaves to their investors, as they should be, right? I mean, their investors want some sort of return, but there's also a long-term thinking about this. Is like, now is the time to kind of invest and double down on things instead of, cut, right? I mean, there's a lot to be done here, right? And I don't know what companies are kind of taking that strategy. I think most people are going to cut expenses and do that. But I mean, I would say might be a great time to start a business. It might be a great time to double down on your business.
I completely agree. But I also wonder, because I wonder about this myself, man, because, let's get like personal about this, right? My business, I do consulting, right? I tell business what to do. I like to think I'm adding value, but you know what I'm not doing? I'm not producing chickens, right? I'm not building houses.
Right.
And so if we are in this great reset where it's no longer about, sort of I don't want to use the word fantasy because it's not really what it is. It's like nominal maybe, or monetary, right? Value versus like real value, right? If we're in that great reset, you know what I mean? Like, I don't know. I might have to go learn how to be a farmer, right? So that is one thing to consider. So from a vendor standpoint, I think the question is, okay, as a vendor, your technology or your product, your service, whatever it is it part of the real economy or is it part of the sort of the monetary economy? I think that would be the first question I would ask, if that makes sense, right? So if you think about prop tech, right, and this is something I saw a little bit at Blueprint, that event I went to. If the prop tech is we're a CRM platform so that real estate agents can stay in touch with their sphere more effectively, right? Okay, is that entire value chain, is that creating a single like house? If the answer is no, I'd be real worried. I'm not saying there's no value. I'm saying I'd be concerned. I would have to take another look at what is the value chain, what is the true value creation, blah, 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 blah. Versus there's prop tech that I saw a lot of that were building tech, right? That were like, we have this new thing that's going to cut your whatever materials usage by 30%. Like, to me, that's part of a value chain that creates a physical product. Do you know what I mean? Those are thoughts that I'm having, man. Because let's put it this way. One of the things that maybe you and I need to talk about at some point, but I wrote a post about this. We have 1.6 million realtors in the country, right? We probably only need about 300,000 realtors. If we have 1.3 million additional construction workers, as a whole economy, society, we'd be in a much better place, right? If we had 1 million realtors leave realtors, buying and selling real estate, and go into building, do you know, like, that's the real economy. Or going to, right? That's the kind of way to think about it, right? So I don't know what that means for industry standpoint. We might have a great reset in the industry where a lot of these companies that have done, like leveraged the internet, and then the internet was like the ultimate, not fantasy, again, that's not the right word, information, it's just bits and bytes. And it's like we're entering this area where bits and bytes don't matter anymore as much as molecules and physical, real stuff, right? Now, we're blessed in the sense that we work in an industry that is the ultimate real stuff, right? Land, buildings, like, that's not going away. It's just our role in that might have to really shift and change. And that's something we're going to figure out, I think, in the next couple of years, because this market is kind of really demanding that.
Yeah, and wasn't it that like Gary Keller was telling at the last mega event or whatever they call the damn things, that realtors should look at becoming financial advisors, right? He was saying that, there has to be some sort of pivot. Now, that's not making something, but that is recognizing, and that's, I've always thought, it's always a vendor kind of conceit, like that they always say to themselves, because the tools or everything they say, like, oh God, if I was a realtor, I would kill it. these guys, that I work with, I mean, they're not using technology, they're not doing whatever. But, and I have this conceit also where I would say to myself, if I was going to be in that business, I'd want to be like, the Wolfman in Pulp Fiction. Like, you're going to call Greg if you need something done.
Right.
Household, he's going to help you sell it. If you need to kind of, who's the best car detailer?
Yeah.
Greg knows.
Right.
I need seats at this. Yeah. I'm going to call Greg. I want to be, that's the guy I would position myself to be.
Yeah.
Like where anything that needs to be done or any recommendation or any kind of, that's who I would like.
The fixer. Yeah.
The fixer in a sense. Totally. Right. And show up and get it done. And and that just builds your rep from that kind of thing. That's how I would approach being a real estate agent. I mean,
look, and again, I'm not saying that I think real estate agents provide enormous value, right? They really do, because the amount of money, the commitment that you're making as a buyer or the amount of money as a seller, like it's such a big, important thing. It really is very similar to like what an investment banker does for a company. I mean, you went through this because you sold your company. Investment bankers provide service that's really valuable, right? So I don't think anything's going to happen with that. The thing to think about in that front is we've had, 10 years, 20 years of various tech vendors making life just simply easier for real estate agents, right? Much more efficient, So we're at a point where the number of homes that are sold is kind of fixed, and it's a macroeconomic thing. So if, let's say next year, 2023, everyone's expecting 23 to be this bloodbath because mortgage rates are going to be north of 8%. No one's going to have any money, blah, blah, blah. Okay, we're probably going to still sell 4 million homes, right? But the point is, I recently brought this up. I know agent teams, like really high producing teams, where they say, if you want to be on my team, you have to do 2 transactions a month, right? So if you look at it, if the average, and they have no problems doing 2 transactions a month because all the technology and the CRM and, the products that you create, the CMA tools, like all of it, they could very easily do 2 transactions, right? In fact, they could probably do 4 a month, and it's not going to be like this, I'm working 80 hours a week to do 4 transactions, because the technology makes that possible. All right, if the average realtor did 24, we only need 500,000 realtors in this country.
Right.
If they did 48, we only need 250,000, right? And the problem for the industry is that so much of the structure, the compensation, the SaaS, everything is built on headcount. And my concern, and I think this is the shift that we're seeing, if we are moving more towards a reality-based economy, right? Yes, we work in a reality-based industry because land, real estate, housing, these things are not NFTs. They're not cruise line vacations. You know what I mean? They're like things that people absolutely have to have. So it's not that the agents are going away. It's that we may not need as many agents. And that then completely changes the financial structure of the entire industry. So if I'm an investor, I'm a VC, I'm looking at, I want to invest in this company. I think the question I have to ask is, can this company survive and be successful with 250,000 agents? Right? Can they? And a lot of SaaS models will not. Right?
Yeah, SaaS especially, right? Because the TAM there is just nothing.
Exactly. And I think that's kind of what we're seeing. The brokerages, I think they're getting hammered because can anywhere survive if we're down to 250,000 agents? Do you know what I mean? I don't know, because you and I both know that the way the compensation structure works in the industry, the fewer agents you have, the worse off you are as a broker, as a franchise, as whatever, right? Can Open Doors survive with 250,000 agents? Of course it can, right? Can Zillow survive with 250,000 agents? Maybe, right? Depends on what happens to buy-side compensation. That's a whole different conversation I've had a number of times. I think it's that sort of thinking, man. And I think that's what's happening to kind of the market as things stand right now.
Yeah, I mean, but it's still a seller's market, right? That's a lot of the indicators say that it still is. There's still a supply demand, right? And this is what I was saying before.
Yeah,
it's so wacky. We talk about this stuff, but it's still a seller's market.
Yeah.
Still, the prices are appreciating.
The bizarrest thing, and here's why, because I think we're looking at it wrong, right? So the transactions are way down, right? Pendings are down, inventory's way up. Prices are still up, like 14%, 20%. Again, I just spoke in Nashville. Nashville, they're still up 20% year over year.
Crazy.
Right? Price. Now, the number of transactions, pendings, all of that way down.
You think that people are they think it's becoming clear, and I'm not even sure if I believe this, that, they're just, the buyers are waiting because, okay, it's coming. They're going to have to, the prices are going to have to come down because these interest rates are going up. I mean,
I think that's what they're thinking. I think that everyone's thinking that. The issue, and I think there's some logic to it because, like I said, my whole theory is we did not have home prices go up. That's my whole theory, right? From 2011 to now, we did not have home prices go up. What we had was money printing.
Yeah.
Right. So if that's the case, then, there is a chunk of the population, let's say the top 20% or so, who benefited immensely from the money printing. Bankers, lawyers, some like people like me, right? We benefited immensely from the money printing. Okay. Those people are going to then say, fine, I'll pay more because I need to live somewhere. Right. And if the option is keep paying rent, because rent's going up too. That's the other thing. It's not like home buyers are like going away and they're like, oh, okay, well, rent is falling too. It's like, there's some sign of that. I just don't get it. I just don't get it.
I don't get it either, man. I don't get it either.
There are some explanations for it, and none of them are pleasant. Let's just put it that way. None of them are even politically correct to say, right? So we'll see. I think we're going to get past this. I think we're probably going to have a bloodbath. I think we're going to have a washout in real estate, just the way we're going to have it in the overall economy, in crypto, and all this stuff. Like the malinvestment, I think it's all going to wash out, right? I would be really concerned about, let's say at a company and my entire business was we help real estate agents with the social media profiles. I don't know if that has real viability if we are shifting from this bits digital economy to a real economy, right? But if it was more like, I don't know, like printing yard signs, that might still be like, because you're producing an actual physical product that is actually used, just as an example. Maybe like the trades, I don't think the trades are impacted. Like if you're a plumber, electrician, home inspector, even like anything like that. Because again, that's like real stuff, real physical stuff. I mean, from a services standpoint, Sonny and I right now having our outdoor like yard done, like landscaping, right? Those guys are providing services, but you know what? It's real services, right? Like they're literally planting trees in our yard because I don't want to have to go plant the tree. It's that sort of thing. I
thought you could become a farmer. You're going to have to learn to do that.
I might have to at this current rate, or pick up some useful goddamn skill, I would end up having to be like a gunsmith.
Oh, God. Yeah, that'd be right up your alley for sure.
So that's, I think that's what's
happening. You think so? Shit show 2023.
I think so.
Is there any bright light in 2024?
I think there's a potential for bright light 2023, and here's what I mean by that. If we are shifting to this real economy situation, the United States, we're in the best position, right? Like there's a guy, Peter Zeihan. It's a really interesting guy, and he recently wrote a book called "The End of the World Is Just the Beginning." Excuse me. And the main thesis behind this book is the entire world is going to hell in a handbasket, but the United States is in the best possible position for a lot of reasons. So the U.S. will be fine. Everyone else will be screwed. If you read people like Doomberg, one of the things they point out is the United States has so much energy and the rest of the world doesn't. So we're going to be okay. So it's possible that we see a pivot from the Fed. In other words, at some point, economic collapse will become so obvious that the Fed will go, oh, crap, we went too far. We need to start cutting rates. We need to start, QE again. Except that the next round of QE, the next round of that might be, instead of investing in like banks and financial services and internet companies, we're going to invest that into factories, farms, oil wells, real estate, Do you know what I mean? Like the companies and industries that produce real stuff.
Yeah, kind of a New Deal
kind of
thing, yeah.
And I could see that happening. And if that happens quickly, then 2023 might not be bad. Right. So to give you a little light pill, like the Senate, the Congress recently passed a rule, a new thing where they're trying to onshore chip manufacturing. Right. So we had offshored it, right? So Intel is building giant factories in, I think, like Ohio, Texas, whatever, right?
I mean, CSMC is just taking over the whole thing. So, and that's one, which is
correct.
Always very, very
correct. So they're already like, okay, we need to incentivize factories. Like we need to incentivize factories here. We know that a lot of companies are going to start doing the same thing. Auto manufacturing, a lot of these industrial companies, a lot of them are going to bring stuff here. Oil and gas is right now a political issue because the Democrats hate oil and gas. But on the flip side, it means Republicans love oil and gas. So if there's a switch, if there's a change in government, it's not that difficult for politicians to go, we're going to encourage oil and gas development, right? So investment might flow into things like that, or solar power or whatever, right? Mining. In other words, like the stuff that we all have completely taken for granted for 30, 40 years. Like we just, as regular people, we don't think about farms. We just don't, right? When we think food, we think grocery store, and you walk in and it's all right there. We don't think about where does this food come from. Now we're thinking about it more. So if we see something like that, man, I think actually 2023 could end up being way better than we think, right?
Yeah, I think chip manufacturing for sure. Geez, we've already seen what by letting that go to some other country. That's
right, or anything. I mean, literally, like, remember during COVID, we were having problems because all of the masks were being made in China. Somebody's gonna go, I'm gonna make a mask factory in North Carolina, right? Now, it's going to be more expensive in dollar terms because we printed all kinds of dollars. But what that could end up meaning, that could end up with is real wages actually start growing, right? Yes, shit is more expensive, but we're not spending money on fake shit. Now we're like spending money on food, energy, real things. So if that's the case, then housing could end up really benefiting.
Yeah, I mean, it's,
So we might bounce back really fast.
Maybe we just go back to building things, actual things,
Wouldn't that be nice?
Yeah, it would be nice.
Wouldn't that be nice? So I think there's some reason for hope, but in the short term, right now in the current trajectory, things are going to get really bad for a while. I think a lot of folks believe that 23, 24 might be like really sharp recessions. It could be depression, right? The money could collapse, the dollar system collapse, all kinds of shit. Hell, man, none of this might matter because there might be a nuclear war and we'll all be, living through fallout.
I was counting the minutes when you're going to say nuclear war. So,
well, do you know what I mean? Like
45, I think we hit it here.
45. So who knows? All I'm saying is like we don't know, but assuming none of those like crazy ass end of the world shit happens, then there's some reason for hope. But I would say batten down the hatches, and that seems to be the way to go. There's going to be a washout. There's going to be a reset because we need to know which companies, which people who are delivering real value to the real economy as opposed to, sort of the money printing fueled value creation, for bits and, bytes and pixels.
Well, I would say kind of wrapping up is my message would be, zig when everybody else is zagging. I mean,
sure.
Instead of, laying off people, hire people, and heads down, make things better so you're ready for that when we get out of this, right? I mean, not play offensively, not defensively. Think about those things. That goes to vendors, that goes to brokerages, and multiple listing services, whoever, right? I mean,
right.
Just because you hear everybody else is doing this doesn't mean that's your. Look, a lot of these guys are kind of like. It's a built-in membership anyway. That revenue is going to go up and down either way. When I was at CMLS, I was asking people, MLS is like, where do you think the membership's going to go next year?
Yeah.
Most of them are saying about the same, right? I don't think, and I kind of agree with that. I mean, you're kind of like, give me a Scoochie face there, but it's going to take a while for these macro things to hit. If they hit, I think agent count. And
I think they're already hitting.
Well, it's 1.6 was just something they announced like last year. That was just up. It's crazy.
I know. What I mean is I heard, again, I'm just relaying stories I heard at that event there was one of the speakers was telling a story. I was talking to an agent in San Diego who said last year in 2021, I did 20 transactions, which in San Diego, as you can imagine, is, I mean, that's probably 20, 30 million in volume, right? Yeah. This year, he's done 3.
Yeah, ouch.
How long is he going to stick around the business? Right? And the newbies that are coming in now, like, how are
nobody? I mean, even the one that's been around, they've never witnessed a market like this. They have no idea to deal with this kind of market.
Correct. Sure. So I don't know if 1.6 is reasonable next year. I mean, I would think it's going to decline. Right?
What do you think it's going to decline? I'm going to write this down here.
Oh God, I don't know, man. Let's just say 20%.
Okay.
But I think that seems like a reasonable thing, and then probably the year after a little bit more.
Right. I mean, if we I know this information's out there, but I wonder what historically has it ever gone down in our membership?
Yeah, I actually have those.
But I know it's been rocketing since like the late 90s or something, right?
I actually have this for you. Why do I have it? I don't know, but I have it. So let's see. Realtor members. Okay. Hold on, I have a better one. Oh, God damn it. It did go down historically. All right. So let me share this. And I know the people who are just listening, they love it when I do this. But, So this is realtor member count from 1975 on versus home sales. Okay. So we see, I mean, it's pretty consistently up, but there was a big drop from 80 to 81, right?
761 to 695. Okay.
Yeah. And then, sort of dropped to 82 and then starts going back up in 83.
Wow. 87, 806,000. 88 was 808,000.
Yep.
Yeah.
And the 822, 810, and then down in 1991 because there was a little recession in 90, right?
729, 719 in 1995.
Yep.
So these are swings of like 22, 17, 4.
Yeah, these are all recessions. And then 2000 hits, right? These are the bubble years.
Right.
Right. So went from 800,000 in 2001 to over 1.3 million in 2007 because of bubble, right? And then it dropped in 2008, right? To 1.1. It keeps going down to 2012 where it was below a million. And then it starts climbing back up in 2013.
Right. So there has been some fluctuation. Okay.
There's a decent amount, but yeah.
So somewhere, with your 20%, that's kind of bringing down like a 1.2,
1.3-ish. Yeah.
Okay.
I think 23, that seems reasonable. It could be way worse depending on what happens to the economy. Right. So we'll see.
Yeah.
We'll see. Yeah. Real happy, man. Come on, man. Leave us with something happy. Something positive. My positive was, look, short-term pain, but in the long run, we're going to be great because real estate and housing are not NFTs, they're not luxury handbags, they're not cruise lines. These are necessary things. People will be buying and selling houses. They will be renting. It's going to happen. And we're just going to wash out some of the companies and people probably shouldn't be here.
I would say, for me, it's persistence. That's a common theme in my career.
Yep.
Is I just show up and I work, and this is going to be a tough time, sure, but just if you're persistent, you keep at it, and you're going to outlast everything. You're going to have even more experience than you had before, and a totally different marketing. It's going to make you a better realtor, make you a better executive, and make you a better vendor. So just don't quit. I mean, I have this thing on my my monitor I keep here, right? And it's the first thing on here is really basically don't quit. Mm-hmm. The second thing is focus on your own work.
Right.
The other one is create your own lane. I mean, find what you're good at and excel at and do that.
Yep.
And then build your own tribe. I love the tribe I have with, you and the rest of the organized real estate industry.
Yep.
And that we can chat and chalk and do those things.
Yep.
And then the last thing is, and this is the hardest thing to do, is let the market take care of the rest. Right?
Yeah. Yep.
All those first 4 things, I think you're gold.
I'm completely in agreement. So let's do that. Tribe mate.
All right, chocolate.
Keep your head up, everybody. Hodl, and we're all gonna make it. So,
Absolutely.
Like Greg said, focus on what you can control and let everything else just be what it is.
Yep.
But keep listening to us because we're gonna give you a little bit of doom and then a little bit of upside and like light at the end of the tunnel.
A lot more upside.
Yeah, we're optimistic, white-pilled people at the end of the day. Cool. All right, thanks everybody, and thanks Greg. We'll talk next time, man.